Hi and welcome to another week ahead video. Now this week we think the market attention will turn to the US dollar with a bunch of important economic data events, including non-farm payrolls, advanced GDP, ISM non-manufacturing, and of course on Wednesday we have the October FOMC meeting. So let's quickly jump to the video and see exactly how we can prepare and possibly trade these events. Okay guys, as always, we're going to start with our three-step analysis process. Step 1, find the baseline or bias for the relevant currency. Step 2, find the baseline for the upcoming risk events. And then step 3, find possible sentiment shifts that can cause a catalyst or trigger to trade. Now currently we maintain a neutral bias on the US dollar. We saw the previous FOMC meeting in September where the Fed cut interest rates by another 25 basis points to 1.75 to 2%. Now this cut was widely expected and also priced in by the markets. But what was not expected was that the Fed came out with an overall dovish tone at this meeting and subsequently saw a lot of dollar strength from that. Now, there were two dissenters, Presidents Esther George and Eric Rosengren, that did not vote for a cut, but instead to hold rates steady. Now, apart from that, the Fed's updated dot plot showed that the majority of FOMC members did not see another rate cut at that time. Now, it's also fair to argue that the data has meaningfully deteriorated following their last meeting. The biggest one, which saw a lot of reaction in the markets, was the big miss in ISM manufacturing PMI, which fell further into contractionary territory and hit the lowest level since the depths of the global financial crisis in 2019. And we can see on this visualization on this chart just the effect and the impact of that massive drop in the ISM manufacturing PMI. The fact that the drop in the manufacturing sector has started to affect also the services sector should be a concern for the Fed. If we go back to that chart, we can see that in terms of services, that has also been deteriorating on a steadily paced downwards. Now that should concern the Fed in this upcoming meeting. With consumer spending the backbone of the US economy, the recent unexpected drop in retail sales month over month, which came in at negative 0.3%, should also be worrying for the Fed. Although it's important to note that retail control group, which basically aligns closely with consumer spending, is growing at an acceptable pace according to Wells Fargo. Now, there's also been a noticeable slowdown in the recent employment reports, with fewer and fewer jobs being added to the workplace. However, slower job creation is to be expected when the economy is running at 3.5% unemployment, which is very close to a 50-year low. Also, even though the Fed highlighted slowing inflation as one of the main concerns for wanting to cut rates, the recent CPI numbers have been very encouraging. If we have a look at the graph here, this basically illustrates the core CPI year over year as well as the core PCE year over year. Now, both of these two metrics have turned back recently, so that should be less concern for the Fed. We can see CPI year over year coming in at 2.4% core and PCE coming in at 1.8%. So both very close to that 2% target for the Fed. So at this stage, we have both positive and negatives in terms of the data, which could tilt the sentiment either way from here. And this is why this week's data lineup as well as the FOMC meeting will be very important for us to note. Now let's move on to step 2, finding the baseline for the risk events. Now this week there's quite a few risk events lined up for the dollar. We have consumer confidence on Tuesday. We have non-farm ADP coming out as well as advanced GDP for Q3 on Wednesday, of course followed by the all-important October FOMC meeting. On Thursday we also have personal spending, and then we're going to end the week with another ISM manufacturing PMI print as well as the non-farm payrolls. Now, even though things like advanced GDP is always important, the market's main focus in the run-up to Wednesday will be the FOMC meeting, which comes out after the GDP event. So obviously, we will expect some volatility from that GDP number, but we might see less volatility from GDP this week than normal, given that the FOMC meeting is just a couple of hours after that. Now, the highlight of the week will be the FOMC meeting. And going into the meeting, it's important to note that at the moment, a 25 basis point cut has already been fully priced into the markets at this stage. However, it's interesting to note that a couple of investment banks has noted that about 40% of analysts are actually expecting the Fed to keep rates on hold. Some also think the Fed will deliver a hawkish cut, meaning that they will cut the 25 basis points as expected, but they will signal that they are done for now, and they'll remove language such as act as appropriate from their statement and stress and highlight the fact that these cuts were merely a mid-cycle adjustment. But it's also important to look at what type of communication was given by Fed members before their blackout period started. We saw Vice Chair Clarida that made a reference in a speech on the 18th of October that the Fed will act as appropriate, and we also had had Fed Chair Powell on the 8th of October, which spoke about the importance of having a data-dependent monetary policy. Also, no other Fed members made any attempts to walk back the current market expectations. And we should also keep in mind the importance of data points like the ISM reports, which might lead the Fed to think that their fears about trade policy negatively affecting the economy is starting to show up in the data as well. So for now, it seems like the baseline scenario for the Fed is to cut interest rates by 25 basis points and to leave their statement unchanged and reflect that they will still remain data dependent and act as appropriate to sustain the economic expansion. As a 25 basis point cut is already priced in, we don't really expect a lot of reaction from the cut itself, but more from the accompanying statement and the press conference, which will be very important. So then looking at possible sentiment shifts and starting with dovish sentiment shifts, the biggest dovish shift will be if the Fed cuts by more than 25 basis points at this meeting and pre-committing to cut even more in the coming months. This would create a great opportunity to sell the USD at market. Sort of a lesser dovish shift could occur if the Fed cuts as expected, but they place a lot of emphasis on those recent negative data points like the ISM and the employment numbers, and highlight that the risks are starting to tilt to the downside for the US economy. But it's also important here that whatever Fed Chair Powell says about the recent positive data points like the CPI will also be very important. In terms of hawkish sentiment shifts, the biggest and most obvious hawkish sentiment shift will occur if the Fed does not cut interest rates at this meeting. This is a very unlikely outcome, however, as the Fed doesn't really like to surprise markets like this. If something is priced in as much as it is now, they don't normally go against that. But if that does happen, it would create a great buying opportunity for the USD at market. Another hawkish shift can occur if the Fed does cut interest rates by the 25 basis points as already priced in, but then explains that they are taking a wait and see approach to monetary policy and basically calling a pause in the current interest rates. A lesser hawkish shift could also occur if the Fed cuts rates and holds to their data-dependent policy, but they choose to rather talk up the strength of the US economy and highlight the recent positive trends in data like the CPI, and talks back the negative ones like we saw in the ISM. But again, that would be a lesser of a hawkish shift in the sentiment. Then possible currency pairs to consider for trading with the USD. In the case of a dovish sentiment shift, we could look to pair the US dollar against the CAD, which basically remains the strongest bullish currency at this stage given the strength in the recent data points as well as the recent jump in oil prices. However, we need to remember that the BOC also has their meeting earlier on Wednesday, and it'll be very important to take the outcome of that meeting into consideration for this trade idea. If the meeting comes across as more dovish than expected, meaning weakening the CAD, then it would be rather better to pair the USD against something like the AUD, the Australian dollar, which has also been well supported in the last couple of weeks. Now, in the case of a hawkish sentiment shift, we could look to pair the US dollar against the euro, which remains fundamentally bearish given the state of the EU economy, as well as the recent easing monetary policy that was put in place by the ECB. Now, how to actually trade this event, whether we see a dovish or a hawkish sentiment shift, both of these type of events will be valid for trading phase one trades if we get that clear sentiment shift. Now, if you're interested to learn how these phase one shifts and trades work, you can check out our news trading strategy playlist on our YouTube channel, where we post weekly examples of how these type of trades play out. And if we do get a phase one move from a sentiment shift, then we could also look for a phase two pullback of that initial move. Now, we post updates on these moves inside our tradable sentiment shift reports inside the Forex Source under the Market Insights tab on a daily basis, where you can basically see each day which sentiment shifts are in play and which ones are still valid for trading the phase two pullbacks. Now, you can also learn about how these trade setups work during our live analysis webinars that we have each day inside the Forex Source terminal. Guys, thank you so much for taking the time to watch this video. As always, if you find the content helpful, please click that like and the share button, as it really helps us out with YouTube to suggest more of our videos. And as always, if you have any questions about the fundamentals that you would like to have us answer or make a video about, please leave those questions in the comments section and we'll make sure to answer your questions. Until the next video, guys, cheers.